Hello. Episode 23, Pickers Market. We are in the house. What's going on, boys?
Not much. Big day today.
Big day.
It is a big day today. We'll get into that. We'll get into all that stuff. So episode 23. So I've started calling this stuff the I'm trying to figure out what athlete. And 23, got to have the Jordan episode, right?
Yeah.
What else
This is
there?
no question.
Does that mean
Jordan
that
episode.
I have to start doing that too?
No, I'll
Okay.
I'll come up with it every
Okay.
time. Numbers. See, I think this is an old younger thing, or did you guys do this? Is that you would like test your friends on numbers of different people? Would you do that? No, wasn't a thing.
That's no.
Was that a thing for you, Gangl?
Yeah.
Yeah. Well, like we used to do that. So we'll be okay. You'll
All
just you can come in with one of the big ones every now and then. I
All
know we missed a few of them. When we get to 100, we're gonna really have trouble
Well,
with
so
this,
I've got
though.
24. I mean, that one's not hard either.
Well, I got to supersede you on 24 because 24 is my favorite player of all time is Ricky Henderson. He was 24. So you're
That's
done.
your favorite player of all time?
All time. Then
Really?
will never be replaced. It's not even close. He is. If he lived in the social media era, it would be like he would be the number one by far superstar out there. He was
Fair.
just eminently quotable,
Yeah, yeah.
and he was an awesome player. So it was super fun. How am I going to do post 100 though? That's what I'm trying to figure out. Is that marathoners? How do I get that?
We'll worry about that when we get there.
Okay, gotcha.
If we get there.
We're running out of film
Yeah.
here.
Yeah. We're on 23. We got a ways to go.
So before we get into the hot button, I want to talk about what we've got going here, and we've got it going next week, and that's at our Elite Advisor Forum. I'm excited. I think it's going to be a blast, actually. I think it's our best group that we've had yet of guests that are coming in. For those of you unaware, our Elite Advisor Forum is when we bring advisors that we work with in-house, and we try to teach them some things and try to give them some information and also try to entertain them a little bit. And we bring in guest speakers from all of our providers and all of our sponsors that help us out with the event. And the roster is getting better and better every year. And I think this one's the best we have yet. We have people like Bryan coming in from BMO Capital Markets.
He's a big fan favorite of
He
our
is a
advisors.
recurring guest, if you will. We'll someday get him on this podcast. I don't think we're there yet, but someday we're getting him in house.
I think he's come to the EAF 9 times now.
It's been a lot. I don't know. I don't even know the number of EAFs. COVID
Yeah,
just
true.
wrecked me on that. I
Yeah.
have no idea now. But he's been repeatedly. We have Anthony Scaramucci coming in. That should be fun, especially pre-election. That
Yep.
could be really interesting and have some good fireworks. But we've got a lot of other guests. Is there anybody in particular you guys are excited for?
I always like the military guys that you're bringing in. We have
Yeah.
a SEAL guy coming in, usually a motivational speaker, and I think they do a fantastic job of obviously motivating people. And
Yeah.
they have great stories, and I'm excited to see that one. I mean, the last 2 years that we've had them, and they've been different guys, and they've been fantastic.
Yeah, different approaches for the last 2 years. The first guy, I think we all wanted to run through a wall afterwards, right? And then last year's was just really practical. He was much more calm, if you will, but it was awesome still. So
I'm excited for Jeff Sherman.
Jeff Sherman.
From Double Line.
Yeah.
Just because today, obviously, we're going to get potentially a rate cut.
Yep.
And depending on the magnitude, I think his commentaries next week will certainly be interesting, at least to me.
Yeah, he should have a lot to say.
Yeah.
They'll know their stuff there, and it'll be fun to hear from him post that.
How about you?
Well, I got a lot of them, to be honest with you, but I'm really, we have a politics and policy person coming up, right? And I think from that side, that's Allianz that they're bringing somebody by, and I think that's going to be an interesting just topic, and just having, 1 month and change before the election.
Yeah.
I think there's just going to be a lot of stuff to talk about, and I think our audience is going to be pretty entertained by that and engaged, and we'll see where it goes, but we're going to have some fun with it.
Well, you're
Let's go that
supposed to be moderating that. I don't know if you're going to have to.
Moderating, just I'm gonna
A lot
try.
of questions from
The-
the audience.
Am I going to be moderating or herding cats? I don't know
Yeah.
yet. We'll find that out. But either way, we're going to have some fun with it. But we've alluded to it enough here. Let's actually just talk about it. Today's Fed Day, right? It's and the reason we're talking about this one, most Fed days, maybe we would have a quick conversation about it. This one probably requires a little bit more. is that it seems like, and the market sure seems like, it is expecting the first Fed cut in a very long period of time. Has it been 4 years or more at this point right now?
Yeah, since a cut, I
Yeah,
guess. Yeah,
since
it
a
was
cut.
COVID
it
was-
raised in 2022, and
Yeah.
it was a few years prior to that. So
Okay, yeah, because they cut in 2020, right?
Yep.
And when COVID basically cut it to zero, so it'd be tough to go further down than
No.
that. I guess
Zero,
Europe
yeah.
said they would do that, but it was weird. So we're at the precipice of the beginning of cuts, and there's the other part about this one that's pretty interesting, that's different than you and I have talked about this quite a bit, is there's a little bit of uncertainty with this one. Is that normally by the time we get to Fed Day, if you will, we kind of know what's going on, right?
Yeah.
Is there's a very high probability of whatever's going to happen, whether it's no action or whether it's some action, we kind of know. This one, we do get a sense that we are going to cut. I mean, there's a 100% probability, and the market will not be happy if we don't get one.
Yeah.
But if we do get one, there is still kind of a 50-50 proposition. I think what I'm seeing, and you guys feel free to tell me I'm wrong, is it seems like market probabilities are assessing a 50 basis point cut, so a little deeper cut than, but it seems like most strategists and most specialists that we're seeing are talking about 25. Is that fair to say that that seems to be the differential, is that the market is pricing in a deeper cut than most of the people that we listen to and talk to are suggesting?
Yeah, the
Yeah.
probability website says it's, I think this morning it was 60-some%, low 60, it's bouncing,
63.
yeah, 63%.
Okay.
So 30 on a 50 basis point
Yeah.
cut. So again, I agree with you. I think this, a lot of the strategists, when you hear them talk and things aren't that bad, they're kind of questioning why we would do 50 basis points. I'm in that camp as well, just so you know.
Well, I think the Fed lately has tried to be as transparent as they can without directly saying what they're going to do. I think you've seen Nick Timmeros of the Wall Street Journal. He's come out with a number of pieces just before the Fed meeting, alluding to what their plan is. Basically, we really haven't seen that, and so I think the market is certain of a cut, but I don't think it knows. And if you look at the daily, someone had a chart of the daily change in the probabilities of a 25 or a 50, and it looks like a stock or like a
EKG.
EKG.
Right.
It's just like up and down. It's pretty wild at how significantly the probabilities have changed over the last, call it 2 or 3 weeks.
For sure.
Yeah.
I do think 25 is my probability based on who's in the Fed, which we can talk about if you want. Probably not.
So you think 25?
Yeah.
Keith, you think 25 as
Yeah,
well?
I think 25. I think it's the economic activity remains strong enough that they don't need to do 50. In my mind, 50. I think if you go back a month ago and people are talking 50 basis points, that most people would think that the economy is really falling apart, that they need to jumpstart it, and I don't see that. And you've seen retail sales came out the other day were stronger, and just unemployment's at 4.2. It still went from 4.3 to 4.2, so it went back a little bit. I think generally speaking, the last several pieces of economic data we've seen has actually been fairly positive.
Yeah.
So I don't see the need to do that 50 base. I'd rather keep some in kind of the savings count if we need to cut more aggressively later on down the line if the economy's slowing.
I do understand the argument though of a 50, because what does 25 get you?
What is 50? I mean, really, when you're going from 5 1/4, it just,
Yeah,
either
but,
one.
I mean,
is
50 gets you going a little bit quicker, right? I mean,
Obviously,
25, I don't know that it will materially change anything.
On raises, though, would you have said the same thing?
Yeah.
Like
Yeah,
25 on raises?
Like, I think 25.
Because they did incrementally 25 every time, right?
Well, I think
Did they ever go
going
50?
from 0 to 25 does make a difference.
Okay.
But going from like
5 to
5% to
5
5.25,
they jumped it up 50.
Did they do a 50?
Yeah.
I couldn't remember.
Yeah.
Okay.
But
But
it
they
was
did a
later.
75.
Yeah, they did. I think they did 175 as well. I
Yeah.
think they went 25, 25, 25, and there was a 50 and then a 75, and then that's obviously.
Well, that
how
was
you
when,
get-
inflation was going insane,
Yep.
right? Yep.
But yeah.
But that, again, signals to me on the upside is like, oh, inflation has gotten crazy out of hand. We need to be more aggressive here. As you said before, on economically, there doesn't seem to be anything that would say things have gotten out of hand. We need to be more aggressive. So I hear what you're saying about does 25 do anything? It's a signaling mechanism. Hey, we're on that path. That's kind of where I think it is. But I hear you on saying, if you really want to do something, you probably need to let's
So I think that's
let's turn the dial up a
I
little
think
bit.
That's what the market's probably saying is like you are seeing consumers that are stretched right now, and you're seeing it. I mean, retail sales was good, but I mean, I think you're starting to hear more commentary. You're starting to see delinquencies rise on credit cards. So I think people are just feeling the burden of price hikes that we've seen. So I think the market is saying 50 would really actually make a difference versus just doing 25.
So-
but strategists say 25 is.
Are you in what camp are you in?
Oh, I'm all in 25. I don't get it from. I hear you on the 50 and starting to do something of magnitude, but if you're saying you're data dependent, there's nothing in that data that would suggest that we need to be aggressive here.
But I do think we're doing 25. Like I'm not in the 50 camp.
No. I know. Yeah. And I would say I understand the argument that you're putting forth.
Yeah.
From my side, it is, I mean, if you just think about the last 3 points, right, is that jobs didn't get materially worse. They're still soft. That's probably the most likely reason to give yourself 50, right, is saying the jobs market is starting to get a little dicey here. But inflation trends were actually a little hot. That's, it wasn't ridiculous. It's not like we're re-engineering it back upward to 9, but we did not go down as much as people had anticipated, and we're certainly not collapsing there. And then, as you said, retail sales. So from my side, if you're saying you're data dependent, I don't know how you say we need to be aggressive right at the outset. Yeah. I think you start in saying things are okay out there, but we can probably start easing off the brakes, if you will.
Well, going to my Fed comment, so I think it does matter who's on the Fed too. Okay. So I was looking at the current Fed members and where it shifts into 2025. So just for listeners, there's 12 voting members on the FOMC, Federal Open Market Committee. 7 of those are board members. One of them is always the New York Fed. I don't know why they don't just put them on the board, but they reserve that for the New York Fed. And then there's 4 other Fed presidents that it rotates through where they get to vote on the policy rates. If you look at the current makeup of the board, it does lean a little bit more hawkish. And then if you look at where it shifts to 2025, you get 4 of the most dovish Fed presidents or board members in 2025 on the FOMC. So I do think we are leaning a little bit more hawkish. So I don't think any of them would really agree with a 50 either, just based on their historical pattern.
Yeah.
Just throwing that out there. But then I think that shifts 2025. Chicago Goolsby comes on, and I think you do get more dovish voices on there. So you could see a pickup in rate cuts in 2025.
Gotcha. I mean, that's actually a question I was going to ask you all. Is like, does the initial cut matter, or does the magnitude that they put forth in the commentary and saying this is the path we see, is that more important? Like, which is more important to you all, that we started and what we started with, or where the path is going?
Go ahead.
I think it's the path where we're going to the end. They won't say an end game where they're going to, but if they're starting, right? So then once you start, you're going on a path somewhere. And I think that's what will be important today, to listen to what the commentary is. Yeah. And how aggressive. Like at Jackson Hole, he basically said that we're having a cut, and that's why everybody's 100% probability of a cut. Yep. Now, was it 25? Is it 50? Okay, so it's either one. One of the two is going to happen. And then now the question will be what's going to happen by year end and into 2025. You're starting to see a lot of numbers already saying over 100 basis point cuts between now and year end, which seems a little aggressive to me. Less economy starts
wicked aggressive to me.
So we'll see, but that's the commentary I think that will get the market going one way or the other. How about you, Tyler?
Yeah, I think commentary is going to be the most important thing. I think Powell always sounds somewhat dovish. I think he's listed as like a neutral, but I think the way he frames the Fed discussion is dovish. So I think people will be happy with his commentary, but I think because he's not going to come out and say we're going to do 25 today, 50 in November, and 25 in December. No, right? Like that's kind of.
They'll never pigeonhole themselves into a particular action.
But I think it depends on how dovish he sounds.
Okay.
After his remarks and starts taking questions.
Gotcha. All right, we've talked about data dependent. Tyler, nerd out for us, a semi nerd, a mini nerd out, if you will. Explain to us, because data dependent, you always hear about dot plot, right? Can you explain to us just quickly what that means?
Okay. Let's see.
That's a big breath in. I'm nervous here.
Well, a small nerd. That's not easy to do. So every other Fed meeting, they release updated projections of what the members of the FOMC believe. Yep. Right. So they put out economic predictions. So GDP growth. They put out unemployment rate expectations, and they put out PCE inflation numbers as well for this year, next year, 2026, and then long term is what they call long term for every year after that. Yeah. But then they also have this dot plot where they all expect the policy rate, the Fed funds rate, to be this year, ending 2025, ending 2026, and then their long-term projections. And so what's a little bit different about the dot plot for the policy rate versus the others is you can see where every member on the FOMC that has a vote, where they think their projections are. So
those are the dots.
Those are the dots. So I think that's also why it's important to know who makes up the board, because you kind of know who is who for the most part, like on the outer edges, right? As you get into the middle, typically there's a clump in the middle where the majority of them believe it's going to be, and then there's others on the outskirts.
Yep.
And you kind of know who those are, which is why it's important to know who makes up the board. But it gives a projection of the median or the average of where all of the members expect the rates to be over the next 3 years and the long term, basically.
Yeah, I think that's exactly what it kind of sets. Hey, what are we
Sets
thinking?
the tone.
How different are they? How wide are those dots on a different basis? And what does the average look like?
What I thought was interesting about it, and we'll get an updated one today because we didn't get one last month, so we'll get an updated dot plot today. I'm not a big dot plot nerd in that sense. Like I'm not gonna. I don't know. Whatever. But what was interesting was shortly after we saw inflation and they started to raise interest rates, all of the dots were on the same line. Like everybody was on the same page. We had to raise interest rates, and it's usually you get some dispersion in there. Someone wants to raise higher, someone wants to raise less, but they were
trend the same, but magnitude a little different.
Yeah, but they were all in a straight line, which normally doesn't happen. So I don't know. There must have been something. I don't know.
That was probably the chairman kind of.
I was going to say,
I think
Jerome probably had a little consensus meeting. We got to come together for this.
Yeah, but now you're starting to see more dispersion, which I think is good because that opens up the discussion and people actually can read into like maybe they are having meaningful discussions about lowering the rates or not lowering the rates based on what they're seeing. But if you see something all in a line, it's like, is someone just making the call, and is Powell just making the call and telling everybody to follow in line? And
So,
now, since we just talked about the dot plot and 25 versus 50, what do you think the market reaction is going to be? I think that's very important.
It's what I always say is that the first one is probably not the sustainable one. It's going to have. Here's my opinion. In 25, it might initially react negatively because you'll get the people out there. We're not moving fast enough. The things are getting worse out there, and there might be a sell-off from that. And just because the probability is higher for 50 basis points, I don't know if that holds. But I also think you could have a negative sell-off from 52 from the people like us and saying, what are they seeing we're not? Because this is, you're starting off aggressive, if you will. So I think that there's more consternation about this than anything else. I don't necessarily know how either of these creates a significant level of positivity, but I'm open to being wrong about that. My side from this point, in my opinion, and this is always my opinion on this, is that once we get this, we'll move on right to the next thing. We'll be like, okay, there it was. We're going to get an immediate reaction. We'll hear the commentary. Okay, we kind of got the trajectory there. Oh, what does jobs look like? I think we're just going to move right on. And after that, and then, those kind of points will put it together. And again, we've talked about this for a while, is that we might just bounce around here and end up in the same exact place we were 3 months ago. I still think we're in that camp. I just don't think that there's a lot of conviction either way right now.
I think if you get a 25, I think the market sells off today. And then I think it's over the next week or 2 weeks, I think it slowly comes back. I think if you get a 50, I think the market pops a little bit, but then sells off the day after. Just because I think as you look into it, like 50 means that they're seeing something behind the scenes that maybe we're not seeing. So,
that's kind of the camp I'm in. I think if we get 50, it's it's great, and all of a sudden I'm like, maybe it's not that great. So then you kind of get that. Again, we're at high levels of the market again. The S&P is almost up 20%, so it's anything that's not picture perfect.
Did we close at all-time highs yesterday?
I think,
or just underneath.
I know we hit them. I don't know if it closed.
I think it closed a little bit lower.
Did it? Okay.
So anyway, we're right there. It doesn't. There's always something that kind of surprises the market a little bit to kind of do a little bit of a sell-off or minor correction, and this maybe is the event that's going to do it 25 or 50,
Yeah,
right? Maybe it's just like
Yeah.
market's like, okay, we've had enough. We've had a great start to the year, and we'll solve a little bit.
Yeah. I mean, at the end of the day, it's a coin flip, right? I mean,
I do think you get a rally in small caps and mid caps, though, especially if you get a 50.
On a 50?
Yeah.
Okay.
We've kind of had that recently, so
Yeah.
we'll see.
see if it-
Interesting how
Maybe
long
it's
that
priced
lasts.
in already.
Yeah.
But
I just think personally everybody's a weak hand right now. I think
I
I think
get
there's
that.
no trends that hold very
Yeah,
much, and
that's
I think
well
everybody
said.
will kind of wait till mid-October when the earnings start coming out, and then we'll kind of develop a sustainable trend for into next year because you'll start talking about it and that kind of stuff. But until then, you got an election
Then
in
I would say then
November. I just
election's
think
right
you
after
just
that,
got a
so
lot of
very-
bouncy stuff right now, and I don't think you've got a lot of strong hands either way. So I think the best trend is probably if this sells off, we probably recuperate it. If it goes the other way, we probably come back to where we are right now. And it just bounce around. So, all right, let's move on. Let's do a quick one. We haven't done a wait what in a while, but this one got me, and so I had to throw it out there. 2 recent sales that caught my eye in the commercial real estate market. Caught my eye, and I was like, I had to triple take. So right here in Minnesota, for this one is just happened, I think, very recently, in like last week or so. There's a downtown office building called the Oracle Center, but ironically, Oracle no longer is there, so they had to change the name. I don't know what they changed it to, but it used to be called the Oracle Center. Office building, 2 buildings, nice area, right in the middle of the downtown. You would think a relatively, decent market price. And in 2019, it was a decent market price, $74 million it sold for in 2019. I just dropped my phone. Sorry. In 2024.
Flustered by the
Yeah,
price
exactly.
drop.
This is why. Because it just sold last week for $6.5 million. 2019, it was $74 million. 2024, it just sold for $6.5. So I was like, okay, that might be a one-off. And then I looked at another one in San Francisco. Now, this is from April, but not that long ago. There was an office building there. I can't remember what it was called, like 999 Market or something. But sold for $62 million in 2016. So probably still had some up from 2016 to 2019, right? Because San Francisco office market was probably going up at that time. That also sold for $6.5 million in April in 2024. So basically 90% cuts in both of these office buildings. That is my wait what just right there.
Yeah.
Those numbers are staggering.
do you
to
remember
me.
how big the Oracle Center is, like square footage wise? Like, is it?
It's a big building.
I
can't remember.
looked. Like, it's either 450,000 or 650,000. Which, think about that. The square, and these are big buildings. I went,
Right. That's what I was just going to bring up. Is what is the price per square foot on that?
It's just, I was just thinking, okay, at that building, that shell, like, there's, in Minneapolis here, there's houses on the lake, nicer lakes, can go for that $6 million.
Oh, 6
right?
plus, yeah.
Plus, whatever, but just say $6 million. And these are probably 5,000 square feet a house, right? Maybe. I'm just roughly, but it's just like, and I was doing the math yesterday when I read the article too. I'm like, so you're going to get, let's say 500,000 square foot building.
Yeah.
2 buildings, really.
Yeah.
And it's just, you could, in theory, right, you cut it up and, whatever, how many floors, I forget what it was, it's 20-some or something like that.
Yeah, but it's a dual building, right?
It's a dual building, right? I mean, if everybody had their own floor of a commercial building, you could, how many units that you'd pay, I don't know, 100,000 or whatever only for that compared to what, it's just kind of mind-boggling that something can go for $74 million down to 65. And part of it is all the upkeep and taxes, because we've seen this when cities start to slow, right? It's just like, the
Fire
owner
sale.
just walks away
Just
because
wants-
because I don't want to
It's a
put
write-off.
any more. Yeah, I don't.
I'm
pure
done
write-off.
with this thing, and I'm just writing it off to zero. I'll get whatever I get for it.
But you think at some point in time someone would step in and revitalize or recondition or repurpose that building to something.
Well, you would hope this price is low enough that you could do things like that, right? Because if you're selling it for, from 74 to 50, right? It's like, well, that's not enough for me to recuperate the cost of really reconstructing this thing to be useful in some way, shape, or form if everybody's still kind of hybriding it at work, right? So I need to reconstruct it to something else, whatever that may be. Yeah, this might be the price that, they both sold for 6.5, which kind of made me laugh. I was like, so is 6.5 kind of our zero number here? That's
Just need
where
something.
Yeah,
Need
exactly.
something
Just give me
back.
something out of this thing to pay, to pay the office staff for writing the paperwork up. But from that side, I mean, these are the kinds of things I think you do need to see for that reconstruction element that you're talking about, is that we need to repurpose a lot of these buildings. There's just no question about it. I don't think we're going back to where we were before.
I wonder what it might be. The 6.5 commissions.
No, someone's gonna get paid.
Commissions, lawyer fees.
Yeah.
Lawyers are going to get paid either way. So I mean, there's probably some magic in that.
So the person selling it probably takes a 0, and then the 6.5 is probably the fees to the brokers, the lawyers, and
So that's a sell price. It just gets passed right up.
So my question to you guys on this, though, when you see these kind of numbers, like, who loses this? Like, this is who's the biggest loser here?
Obviously, the person that owned the building, right? There's usually an owner of some sort, whether it's a corporation or something. I think they take a loss, but again, they offset some of that with a tax write-off. The city itself loses, right? Because it's a property tax here. Now, again, I was looking at this like, how is it compared to a housing market, right? When housing prices drop, that doesn't necessarily mean your property taxes are going down as quickly as the prices drop back in the 2008 situation. So my guess is,
but if you don't have a renter in there, that's the problem. If you don't, Oracle moved out. It sounded like there weren't that many people in that building. It didn't sound like there were a lot of tenants.
But whoever's paying, if it was worth $74 million, you were paying property.
You still got to pay
on
property tax,
right?
on
You're
it.
still paying property tax on it. I looked at San Francisco. I think their budget was half of their city budget is property taxes paid on the building.
Got it.
So now it's like, okay, you cut from 74 down to $6 million. I assume the city's not going to say, okay, we're just going to take it. Property taxes valued on $6 million. They're going to walk it down, right?
Yeah.
So I think the city's a little bit of a loser there, right?
Gotcha.
So the property tax is coming in.
I think shareholders if there are shareholders of the company that previously owned it, those probably are losers as well.
Yeah.
And then I think in some of these instances too, though, is like you said, these guys are they're done with it, and they're going to take the taxable loss on it to offset something else, or carry it forward for God knows how many years, right? Like, it allows them to maybe be more flexible with some of their other properties that they want to offload in the future.
Yeah.
So it could just be a long-term strategy for some of these companies that are able to take that kind of loss. Obviously not every commercial real estate company can take that kind of loss and continue on.
Yeah.
But I think from the bigger guys, this could just be a strategic play for them just to get out of something that they're paying property taxes on $74 million. They're like, we literally have no renters in house. Just get rid of it.
Yeah. Your operating costs are just still eating you alive, so just dump it. From my side, where are we at this one? Are we in the second inning? Are we in the 7th, 8th, 9th? Where are we in this cycle? And where is that if we're talking about who loses, one of the things we didn't mention were banks, right? They're wearing a lot of this stuff, right? From loans and all the other stuff that goes in it. Are we at an area where this is still more to come and there's still more influence here? Is this going to have an effect on the overall economy? What do we think about these? Are these just rando events, or is this something that we need to prepare ourselves a little bit more for?
I would say we're overall in the earlier innings of it, just to realizing the price. I think people realize the prices have come down. Until it actually hits the paperwork at $6.5 million, 90% write down, and then it's the banks. I think that's when so that's why I think we're in the early part. I think the price is dropping. I think we're towards the end of that part of it.
Got it.
So, but I think that the realization of the losses were in that early mid part of it. So, which I think it gives cities black eyes. It's like, now what do we do with this building? Now it's empty. It's just less tax revenue, and you have to do something with that building. You just can't leave it empty.
I think we're probably in the second or third. I think when the Fed started to raise interest rates, I think the commercial real estate market was really on freeze, right, for a year and a half. There weren't any buildings that were selling, which meant that they couldn't price them, right, because nobody was selling anything, so you couldn't mark to market your actual building price. Now you're starting to see some of these more in a fire sale type of way, so I don't know that this is a broader thing that these companies are going to mark every building down 90%. But I do think we're starting to realize that these buildings are not going to sell for what they sold in 2019, 2020, because you can't have the interest rates that you have and then no renters because half your workforce is working from home.
Yeah.
or companies are just downsizing because you're remote half the time and half in, half out. Right?
Yeah.
So they just don't need the square footage.
Yeah.
So I think now we're in the realization phase, as you said, of where these prices truly are. I think there's still an area that we have to these companies need to find where that price truly is. Like, is it a 20% tick off of mark-to-market prices? Is it 30, 40? Certainly not 90.
Right.
But I think they have to find the right level still before they actually start rolling out.
Yeah. You just have to see more transactions. I think that's probably it. And one of the things I always caution people on is just because we think this is early, I mean, there are certain buildings. There are buildings probably 2 blocks away from these buildings that are probably selling at the highest price they've ever have because they still have renters. People like them. They've refreshed them with amenities. It's a gorgeous spot and all that stuff. So real estate is not pure trend, right? Is that, a lot of times this can be similar to stock market. Is there natural trends that come as a result of this? But one company may have a very different than the company right next to it that does a similar business. Auto parts is probably a good one. There's been really good companies in there, and there's been really, really one bad one. And so those are the kinds of things that can happen in the real estate market as well. Is that if just because a neighborhood or this something, it doesn't mean it's endemic to the whole thing. It could be just this one. They never refreshed it. It just got ugly, and a big person left, and nobody's there to replace it. So I think I agree with you guys. I think this is early components of this. I think we're going to see more of these types of transactions because it will allow that opening up to adjusting that space in the proper manner. This is what you need to do that.
I think going back to your initial question, though, of maybe it wasn't the initial second,
whichever
the
one,
ancillary question about the banks. I do think there will be some pain for some of these regionals.
We have to be careful on that. I think you do. We don't own a whole heck of a lot of regional banks for that reason. It's not I'm saying they're going to fall apart, but if an area does get hurt, they're probably the most likely to feel that.
Yeah, you certainly don't want to have a loan on that bank or that building that just went from $74 million down to $6.
Well, and I don't think a lot
the banker's
of these,
sitting there. He's sweating. He's sweating hard.
Well, I don't think a lot of these commercial real estate companies have even if we drop prices 30% or 20%. These commercial real estate companies don't have 20% equity built in from the price that they buy.
They lever these things up aggressively.
So it's like, even if we take the 20% hit, that's potential for default on that loan.
Yep.
Right. So
I think you'll see, default will happen. I think there'll be more defaults than less, right? I think that'll absolutely happen. I just think you're going to see a lot of workarounds too. And the thing that might actually, the extend and pretend, I think, is absolutely a viable strategy for real estate because it's not going anywhere, right? So the extend and pretend, it's actually going to probably, if interest rates do get cut here, that actually might help them extend and pretend a little longer, reestablish new debt, extend it out, take the hit through the debt change and all that fun stuff, but it's still not fun for the bank. Yeah. The bank's earnings don't accelerate because of those issues. They usually go the other way.
Well, and I think that's why you've started to see some, not necessarily commercial real estate, but real estate sector within the S&P or the market, I think start to rally the last couple of weeks on the back of the potential rate cuts.
Yeah. Cool. All right, boys, we're going to wrap it up there. We usually do spaghetti well, but we nailed a lot of stuff here today. So I think we did our job. So tune in next week where we have another hot button, and we'll probably come with a spaghetti wall at that point. Till then, take care, everybody.